Welcome back, CA Intermediate and Advanced Accounting students. You are probably deep into your test day prep right now, so let's get straight to it. Today's explainer is your ultimate AS24 revision guide, specifically focusing on discontinuing operations. We're going to strip away all that textbook fluff, hone in on exactly what scores you marks, and, maybe most importantly, expose those sneaky traps the examiner is just waiting for you to fall into.
To kick things off, let's look at a classic real-world exam scenario. Imagine a company decides to shut down just one of its many manufacturing facilities, right? And they shift that production over to another location just to save a few bucks. So is closing that single factory a discontinuing operation under AS24? Well, at first glance, you'd probably think, yeah, they discontinued the factory, right? Actually, hold that thought. That right there is one of the most common examiner traps out there. By the end of this explainer, you're going to know exactly why the answer to that is a hard no and how you can spot the difference instantly.
Okay, let's dive into this. Here is our whiteboard playbook for mastering AS24 today. We'll quickly cover the objective and scope, define a discontinuing operation, pinpoint the initial disclosure event, break down the reporting rules, and finish up by conquering those tricky exam situations.
All right, starting off with Section 1, Objective and Scope. Before we even think about touching the math or the disclosures, we have to establish who actually has to apply this standard. The whole point of AS24 is to help people reading financial statements project future cash flows by basically separating what's staying from what's going. Now, according to the ICAI applicability chart, Level 1 enterprises, yeah, they must fully comply with AS24. But Level 2 and non-corporate Level 3 entities, they are totally exempt. So if an exam question specifically mentions a Level 2 enterprise, don't you dare waste time applying the standard. Just state the exemption, grab your easy marks, and move right on.
Moving right along to Section 2, Defining a Discontinuing Operation. Listen, this definition is the absolute core of the exam. If you misclassify an operation here, your entire answer just goes right off the rails. The standard formally defines it as disposing of a component of an enterprise pursuant to a single plan. But, how you actually dispose of it can look pretty different. It could mean disposing of it substantially in its entirety. Think of a mega transaction, a demerger, or a massive spinoff. It could also be a piecemeal disposal, where you're just selling off assets and settling liabilities piece by piece over time. Or it could literally just be abandoning it completely. But here's the catch. The disposal method is really only half the story.
For it to truly be considered a discontinuing operation, the component absolutely must meet all three of these mandatory conditions. First, it has to represent a separate major line of business or geographical area of operations. Second, it must be distinguishable, both operationally and for financial reporting purposes. And third, it has to be subject to a single overarching plan of disposal. Please, whatever you do, do not let the examiner trick you on this. If a scenario only meets, say, 2 of these conditions, it fails the test. It's not an AS24 discontinuing operation. All 3 are completely non-negotiable.
Notice the stark contrast here. Let's look back at our hook question from a minute ago. Remember? Closing one facility or just shifting production? That is really just a standard relocation or a productivity move. It is definitely not a discontinuing operation. Winding up a tiny, insignificant operation? Also not discontinuing. But let's say a company sells off an entire product division that pulls in 30% of its total revenue, and it is a clearly distinguishable segment. Boom. That absolutely is a discontinuing operation. You always want to be looking for that major distinguishable shift.
All right, Section 3, the initial disclosure event. So now that we know what qualifies, let's see how this whole timeline actually builds out. The trigger, what we call the initial disclosure event, happens on the earlier of 2 specific dates. It's either when the enterprise enters into a binding sale agreement for substantially all the assets, or when the board of directors formally approves and announces a detailed plan for discontinuance. Whichever one of those happens first, that's your trigger. From that exact moment, your disclosures have to commence in that period, roll through any interim financial reports under AS25, and just keep going until the disposal plan is fully completed or, abandoned.
Which brings us to Section 4, Reporting and Disclosure Rules.
We are now in the execution phase. This is what you actually have to write down in the financial statements to get full credit. And honestly, this brilliantly illustrates one of the coolest, most unique things about AS24. It doesn't actually have its own math. It does not lay down separate recognition and measurement rules. Instead, it's purely a standard of presentation. It basically borrows its measurement principles from its friends, other accounting standards, to figure out when and how to recognize the financial effects.
Because of that, when you are tackling an AS24 problem, you are going to need these 3 standards on speed dial.
You'll apply AS29 for any provisions related to the discontinuance, like restructuring costs. You'll use AS13 if the disposal involves selling off investments. And you'll look to AS10 for any impairment or write-down of property, plant, and equipment. Now, a really quick warning regarding AS29. Just merely announcing a discontinuance doesn't automatically mean you get to recognize a restructuring provision. You still have to meet the strict criteria of AS29 first. Basically, there has to be a valid expectation raised in the people who are actually affected by it.
Once that initial disclosure event triggers, here is your mandatory checklist. You've got to disclose a description of the operation, the AS17 business or geographical segment it belongs to, the date and nature of the trigger event, and the expected completion date. On the financial side, you have to show the carrying amounts of assets and liabilities being disposed of, the revenue, expenses, pre-tax profit, related income tax expense per AS22, and your operating, investing, and financing cash flows. I know it's a lot, but chunk this list in your memory for the exam. Oh, and crucially, if it's practicable, these items should be shown squarely on the face of the statement of profit and loss, not just buried somewhere deep in the notes.
Okay, pay really close attention to this next part, because I want to be incredibly firm here. Retroactive restatement is strictly prohibited. Under AS24, you do not go back and restate amounts of assets, liabilities, revenue, or cash flows for prior periods just to reflect the discontinuance retroactively. Seriously, do not let an exam question bait you into adjusting last year's numbers. It is a massive red flag.
Finally, Section 5. Conquering tricky exam situations. Let's jump right into our rapid-fire cheat sheet for the most common curveballs those examiners just love to throw at you. So the crucial point here is applying that earlier of rule we talked about. Take a look at the first situation. If a binding sale agreement is signed before the board even formally approves a plan, what's your trigger? Well, it's the date of that binding sale, simply because it happened first. Conversely, if the board approves a formal plan before the year end but a sale agreement hasn't been signed yet, then the board approval is the initial disclosure event, and you absolutely must disclose it in the current year's financial statements.
Next tricky scenario. What if the initial disclosure event occurs after the balance sheet date but before the financial statements are actually approved? Well, you treat it exactly as an event occurring after the balance sheet date, as per AS4. You provide the disclosures as additional information in the notes, but again, and I can't stress this enough, you do not restate the primary statements. And just as a quick refresher, winding up a tiny insignificant operation, not a discontinuing operation at all. Please don't waste your precious exam time applying AS24 disclosures to it.
All right, we've covered the definition, the triggers, the rules, and the traps. But let me leave you with one final test question to see if you are truly exam ready. Let's say a company makes a huge announcement, starts all the AS24 disclosures, but then next year, the board gets cold feet and formally decides to abandon the discontinuance plan entirely. Do you just pretend it never happened? No way. Under AS24, you must explicitly disclose that fact, the reasons why they abandoned it, and the financial effect of that reversal. It really leaves you wondering, though, if you were the auditor walking into that room, would you catch a company trying to sweep an abandoned discontinuance quietly under the rug, or would you hold them to the strict disclosures of AS24? Keep that critical auditor mindset as you walk into your exam, and you are absolutely going to crush it. Happy studying.